Welcome back to the LPR Trading Group YouTube channel. It's Dave again. I've got module 4 here for you on the market profile and understanding little course that we're putting together. We're going to be talking about balance and value here. We're going to be talking about POCs and NPOCs here. So a POC, or a point of control, is where the market has spent the most time on a given session. This is balance in the marketplace. NPOCs, or naked point of controls, is a point of control that has not been retested by price. So it's a previous point of control, or a point of control from a previous day that laid itself out just like this, and then the following sessions have not come back up to retest this point of control. So it's naked. It has not been retested. I recommend using POCs and NPOCs as targets in the marketplace rather than areas to trade from. I typically trade these areas exactly like I trade poor highs and poor lows. If I can find a trade down here in the market to be long, okay, I will look to have this area as one of my targets. If the market is trading into these naked point of controls, I wait for the bigger players to show their hand, okay? I wait for the bigger players to show their hand, and if they're holding this naked point of control with volume, I will look for long trades on my footprints for the continuation to the upside. If price drives up into this naked point of control and we reject and start trading under, and I start seeing a lot of sellers coming in this area on the backside of the move, I will look for a scalp model trade entry to get short off these naked point of controls. This is a naked point of control by volume. You can also have them by time, okay? So we're looking for these areas to attract price for rebalance. When we are trading within value, we want to wait for the larger players to show their hand before we execute. Initial balances. The initial balance is typically made up after the first hour of trading. If you take the high and the low of the first hour, you will get the initial balance. So you just put a chart on a 1 hour time frame, for example. The first 1 hour, it's better to put it on 30-minute time frames and take the first two 30-minute bars, so 9:30 to 10, 10 to 10:30. The highs and lows, that's going to be your 1 hour initial balance. I also use the 30-minute initial balance in my trading. When looking at the initial balance high and low, you would be able to get a good idea of what day type is going to play out in the market. Example, if the 1 hour initial balance is very small relative to the previous day, we will likely have a non-trend day or a double distribution day forming. Okay, so if we look at this example on the right side here, on my profile or market profile TPO chart, this blue bar represents my initial balance for 1 hour, and this is my 30-minute initial balance. You can see that this initial balance range is very small relative to this initial balance range. So we have a small initial balance, chop, 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 sideways, 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 before we really pressure cook in this range and we start getting explosive moves to the top side. Okay, we could also explode to the downside, but typically if you have small initial balance ranges, it's going to be on maybe like a half day in the marketplace where we're just chopping sideways, or a day where there's a lot of accumulation or distribution and you can expect a move, a rather large move, in either direction. A double distribution day, like we talked about previously, has a profile that looks like this. And the way this profile plays out as the day progresses is this lower bulge in your curve here is the accumulation at the beginning part of the day. This lower volume area is the drive to the upside, and then we get that late day accumulation up here, or distribution. And that's your double distribution day. Another example, if the initial balance is much larger than the previous day, we are likely in a normal or neutral day. So normal or neutral days tend to have a large initial balance and they just remain range bound. The good thing about these normal or neutral type days is if we have this large initial balance and we're trading from highs to lows of this initial balance, the range is large, right? We can still get very good trades within this range. If this, for example, on ES is like maybe a 30 or 40 point range, we can find some good trades in there. NQ might have a 150 point range. You could find some good trades in there. Large initial balances soak up most of the move earlier on in the session. Then we tend to just range between IB low and IB high for the session. So We've made the move off the open in the first 2 or 3 periods. We have initial balance high, initial balance low, and the market fails to accept price outside of the higher low of that range. Okay guys, I hope you guys enjoyed this module, Module 4. I will be back very soon with Module 5. As always, like, comment, subscribe. I will get back to every single one of your comments down in the comment section. Be safe on the charts. Cheers.